Hopefully you've been reading the disclaimer that's on the screen while I've been talking. Please do have a read while I just tell you these next couple of things. It's really important to remember that we do not offer advice here, and nothing that's said on this evening's webinar is an endorsement or a recommendation of anything that you hear. If you're unsure about any of this, then please do speak to a qualified financial advisor. Right, hope that's given you a chance to read the disclaimer. Well, that's all of the housekeeping out of the way. So without further ado, I will push straight on into the first 20 minutes session, which is really designed to set the scene as an intro. I've got quite a lot to go through. This is the type of slide deck that I could easily spend the whole hour and a half on. So apologies if I go fast. I've got a lot to cram in, but it is designed really so for you to be able to download and take away the slides and kind of digest them and watch it back. So I will go quite quickly. Happy to take some questions at the end. What I'm going to try and get through in 20 minutes is set the scene. What is an investment portfolio? Where do you start? What are the types of key questions that you need to ask yourself? What about asset allocation? A massive topic in its own right. Again, I could do a whole evening on asset allocation, and maybe we will another time, but I'm just going to go through it really quickly tonight. I'm going to introduce the concepts of diversification and correlation. Then think about choosing the different types of investments. What type of things you need to understand when building a portfolio, and then also just identify a few areas where AJ Bell can help you on that journey. So let's start what is an investment portfolio? A really nice basic starting point. Well, I think an easier definition of an investment portfolio is it's a combination of investments put together with the aim of achieving a specific objective. And that specific objective is important because it's your objective. And each of you listening tonight may well have a very different objective. And so there is no kind of one-size portfolio that's suitable for everybody. What are the benefits of a portfolio? Well, it certainly has the potential to improve your long-term returns. It can reduce risk, and we'll talk a little bit about risk later on. It can take away some of the emotional biases that come with investing, and there's certainly lots of behavioural impacts on investing that everybody falls into, so it can help address some of those. But it also helpfully should provide you with a framework to follow to provide a nice set of parameters in the way that you manage your portfolio to give you some guidelines to operate within. So where do you start? What are the key questions you need to ask yourself when you're thinking about building a portfolio? Well, I think first and foremost, you need to ask yourself, what are you trying to achieve? Is it capital growth? Is it income maybe? Maybe you're just entering into retirement, you need to generate an income from your investments. Maybe actually you've built up quite a nice portfolio and your need is actually to preserve the value of that, maybe in absolute terms or maybe in real terms, because you need it to grow in line with inflation, which is obviously very topical right now. And there are other types of objectives that you may have, but they're three of the most common ones. The second question you need to ask yourself is, what is your time horizon? This becomes really, really important because it links through to the next area of risk. Are you a short-term investor? Maybe you need your money back for a specific purpose in maybe say the next 3 years. Maybe you can take a slightly longer term view in the medium term, or maybe you are genuinely a long-term investor. Maybe you're in your 30s tonight, you're thinking about saving for your retirement, and therefore you've got a 30-year investment horizon there. And then you need to think about how much risk are you comfortable taking? Can you tolerate short-term losses? And it's not just about when you need the money back, it's also about the emotional side of it. Are you comfortable with logging on to look at your account and maybe seeing that it might be down 10 or 20%, even though you don't need the money for maybe 20 or 30 years? So that emotional element comes into it in thinking about how you understand your own risk profile. So what about asset allocation? Where do we start? We get asked lots of questions about, well, I don't know how much to have in equities or bonds or cash. Excuse me. The answer to that really is all about the previous questions, the questions on the previous slide about your attitude to risk, about your objectives, about your time horizon. When you've answered those types of questions, you can actually start getting a flavour and a feel as to what your asset allocation could be. You're comfortable taking risk. You've got a very long time until you need your money back. It's for your pension in the future. Maybe it's appropriate to take more risk there. Or I don't like losing capital. I'm a very cautious investor and volatility scares me. Well, therefore, maybe you need a very different portfolio with much less in higher risk equities, and maybe you need to be much more down the conservative end with more in cash and bonds. You also then can start thinking about different aspects of that, about geography. Where in the world do you want your money? Maybe it's in Asia, which may be considered to be higher risk compared to the UK. Maybe it's in smaller companies rather than larger companies. Maybe it's in growth or value, and there'll be terms you might hear more this evening, or if you're investing in bonds, in different types of credit rating there. So there's lots and lots of different objectives and different asset allocations you can have. The reason I'm not really giving any examples here is because there are literally thousands of different combinations that you can have that may well be suitable for your own objectives. But diversification is very, very important. And this chap here is Harry Markowitz. Now, in the 1950s, he wrote a paper called Modern Portfolio Theory. Not so modern on the basis it's now 70 years old, but he really introduced the concept of diversification and thinking about how different assets work together in a portfolio, and how, if you get that right, you can actually enhance your returns over the long term and maybe lower risk as well. And obviously higher returns and lower risk sounds like a pretty potent combination. Now look at an example of this now, and it's a slightly busy slide, but it's just to illustrate in a simplistic way how diversification can work in action. So on the top left-hand corner here, we've got a simple chart of the returns of UK equities and UK gilts per annum for the last decade. The orange bar is UK equities, and you can see that on the whole, they've done very, very well. And the blue bar is UK gilts, and we can see that actually they've also done quite well. The ups haven't been as high as the ups in equities, but equally the downs haven't been as large as the downs in equities. And we see that therefore we get a different pattern of returns. Bonds are less volatile than equities, proven over many, many years of data. But equities equally can suffer large falls in value. Now, that's perhaps not best illustrated on this chart, where we've only got calendar years, but if we think about last March 2020, when lockdown was happening and no one was really sure what was happening with COVID, we saw equity markets falling 10% in a day there. So obviously we had a very different type of performance. If we stitch those 10 years worth of data together, and that's the bottom right-hand chart in the blue and orange bars, we can see where we've got to. If you'd had all of your money in equities, you would have made about 70% over the last decade. If you'd had all of your money in UK government bonds, you would have also made around the same level of return in the last decade. But the journey on how you got there was very, very different. Bonds did very well when equities were weak, and equities did well when bonds weren't really going anywhere. And the silver line in the middle is a simple 50-50 portfolio. I've got half my money in equities, half my money in bonds. That's the result. And you can see there that over the last decade, if I'd done that, I would have got basically a very similar return, but I would have had a much smoother journey en route there. And the concept of diversification and risk is as much about the journey and how comfortable you are on that journey as it is about the destination. If we think about that, I think lots about a flight, and I'm not a great flyer, and I think I can always remember the flights where I've had bad turbulence. So yeah, and I equate stock market volatility to that kind of turbulence. I still made it to my destination, but my journey wasn't quite as comfortable as other flights I've had where I didn't encounter any turbulence. And that's really what stock market investing is about. So let's introduce the concept of correlation here, and this is a really simple example. This is about thinking about, on the left-hand side, we've got a picture of an ice cream van, and if you own an ice cream van, you will do very well when the sun shines, and you will sell lots of ice creams. On the right-hand side, we've got an umbrella seller. you're likely to sell more umbrellas when it's raining than you are when the sun is shining. So if your business is such that you only sell ice creams, then clearly in the winter you're not going to have a great business model. And if you only sell umbrellas in the summer, you're unlikely to have a great business model, although I'm acutely aware that this example doesn't work well in England. But if we think about a business that in the summer sells ice creams and in the winter sells umbrellas, then we've got the concept of correlation working quite well. They sell at different times, and therefore, if we think about a portfolio, then they can work quite well together in the same portfolio. The table at the bottom is a mathematical measure of correlation, and it shows how different assets work together. So if we take the top line on the left, UK gilts, and we look across and we find UK equities, we can see that they've got a negative correlation there, minus 0.13. So that means they're not correlated. They have very, very low correlation. And actually, as we saw in the previous example, having both of those asset classes in your portfolio at exactly the same time was proven to be a good thing over the last decade. However, if we look at UK equities, the next line down, and we go across to global equities, we see a correlation of 0.89. So these are quite correlated. They actually behave in a very similar manner. And therefore, if you have a portfolio of UK equities and global equities together, you're getting some diversification benefit, but not very much. So it is a benefit to the portfolio, but it's not, they don't work in opposites effectively. So you can imagine that when UK equities go up, it's likely that global equities go up, but also the reverse is true when they go down. And I'm not, in the interest of time, I'm not going to go through other examples on here, but I think in your leisure, it's interesting to look at this type of table and think about how different assets can work together. How correlated are they? So what about choosing your investments? Building a portfolio is all about combining assets that work together, and it's all about trying to deliver an outcome for an acceptable level of risk to you. And that's really, really important. It's about your comfort with risk. And it's not just about different asset classes, it's also about within those asset classes. So I've just talked about those different asset classes, equities and bonds and property and cash, as we saw on the previous slide. But it's also thinking about different approaches. You can have equity managers that have quite low correlation because they look for different types of stocks. A growth manager and a value manager are fishing effectively in a different pool, and therefore combining a growth manager and a value manager in your portfolio can bring diversification benefits and can improve your return over the long term. Much the same is true with larger companies and smaller companies, and it is true as well thinking about investing in different parts of the world. UK equities perform differently to Chinese equities, and they perform differently again to Russian equities and French equities. So you get all of these different interaction effects, these different correlations going on, and it's exactly the same in the fixed interest market. Government bonds perform differently to investment grade bonds, they're company issued debt. High yield bonds are higher risk, as the name implies, and emerging market debt too. So all of these things are really important to think about how you build a portfolio together. Think of it like a jigsaw, putting the different pieces together to make the picture you want to see at the end. So a lot of the way that people think about this is something called a core and satellite approach. And what they tend to think about is building the large part of their portfolio in the core, and that might be having the more traditional types of assets. So it may be a multi-asset fund that invests in all different types of assets. It could be a fund investing in larger UK companies or global companies or the larger US companies, the largest companies in the world. It's all different types of things that could be considered a pretty core approach to investing that would be the mainstay of most people's investment portfolio. And again, we always imply most people because there's effectively no two people the same in this example. Once you've got the core of your portfolio in line with your risk profile, then it's interesting to start thinking about what are the different investments we can add around the outside, the satellites, to enhance that portfolio, either to add additional diversification or maybe improve its return characteristics over the long term. So it may well be you interested in adding Asian equities because you think they've got a great chance to deliver enhanced long-term returns, or it may be you want to add some gold because you want to have something in your portfolio that if inflation takes off and everyone's worried about the future, that actually gold may be an asset class that will do well in that. So I've on this slide just given you a few examples of what I would consider to be more of those core investments, and then some of those satellite investments around the outside. And we're hearing from Walter Price at Allianz Technology Trust later on. He may well in his presentation argue that his tech fund should be a core fund. I've added sector focus funds here as a satellite basis, on the basis that traditionally it won't make up the larger part of your portfolio. So thinking about your portfolio in kind of a core satellite approach is quite a neat way, I think, of thinking then about your asset allocation and your risk profile. So last couple of slides here, as my 20 minutes absolutely races through when we do these. I just want to introduce the concept of the illusion of diversification. And it's really, really important to understand how different managers invest their funds. Now, you can invest in 2 different funds from different asset managers, but if they both follow the same approach, i.e. they're fishing in the same pool, it's very likely that actually they will perform in a similar manner. They may even own the same companies. When you lift the bonnet, you may find that those top 10 holdings look the same types of companies, maybe similar weights. It could well be the case, and let's pick an example. If you were investing in 2 US equity funds and they both had a growth tilt, that they will have very similar assets underneath. They will therefore have similar correlation that we talked about earlier, and therefore you are not getting the benefit of diversification. So quite often when people ask me to look at their portfolios, they'll say, yeah, I've got 10 or 12 funds, I'm nicely diversified. But I might well say to them, well, 8 of those funds are investing in exactly the same type of company. Now, some of them might be in Asia, some might be in the US, some might be in the UK, but they're exactly the same type of company, and therefore you've got the illusion of diversification. You're exposed to the same type of risks, and they're likely to perform well at the same time, but they're also likely to perform poorly at the same time. The slightly small table at the bottom is just to illustrate that. Now, these are 4 funds that sit on the AJ Bell Favourite Funds list. They're all global funds, and the point here is to show you that they invest in different ways. So along the bottom, if we start on the left-hand side, it's a value style going to a growth style on the right, and down the bottom on the left-hand axis is small cap, right up to large cap. You can see here very clearly these 4 funds invest in completely different parts of the market. Therefore, they will have lower correlation together. Therefore, there is some diversification benefit of combining them in a portfolio. So I could talk about that for a very long time, but I'm just going to push on in the interest of time. What are the key things to understand out of all of this? Really important that you have an investment objective, that you know what you're trying to achieve with your portfolio. You must understand your risk tolerance. It's no good being a collector of funds and ending up with a portfolio that is skewed in the wrong direction that doesn't meet your risk tolerance. You're a cautious investor with a portfolio full of high-risk funds, or even a high-risk investor with a portfolio of cautious funds. You've got to get the balance right. So think about your asset allocation in respect of your attitude to risk and your objectives, and try and invest in funds and other investments that are complementary to one another. They're not replications of one another. Be patient and stick to your plan. I think it's another really important point. And don't overtrade. Resist the temptation to tinker with your portfolio. So just to sum up, how can we help you? How can AJ Bell help you in that? We have a different range of services to help that. If you really aren't sure what to do at all, you want to outsource your asset allocation, you want to give it to someone else to decide for you, you want to give the selection of the underlying investments to someone else to do it for you, we have our own AJ Bell range of funds for you to look at. If you are interested and want to kind of keep involved, but need a helping hand to start you off, there's the AJ Bell ready-made portfolios. And if you just need some help to do your research, you need some ideas, the AJ Bell favourite fund list and investment trust select list is there as well to help you. All of these things are very clearly signposted on our website. And of course, if you're a confident investor and you know the answer to these questions, and I'm sure some of you do, which is fantastic, then there's the full investment universe on the platform for you to choose from. So just a final thought here from Ray Dalio, who's a hedge fund manager, and I thought he summed up what I've been talking about quite nicely in a simple quote. And he says, you should have a strategic asset allocation mix that assumes you don't know what the future is going to hold. Now, I would contest that nobody knows what the future is going to hold, and therefore the concept of diversification, of correlation, of getting your asset allocation right becomes very, very important. So I have raced through that in 20 minutes. As I said, I'm really sorry that I've had to go fast. There's so much I could talk about, so much I want to talk about. I'll have to beg my colleagues to give me more time in our next one of these that we do. So that's all I wanted to talk about.